Before we look at an options quote and diagram, let's set the stage with an explanation of a covered call, and let's start with a hypothetical assumption. Let's say you own 1,000 shares of ABC Company trading in the 80s, and it's in August, but you're interested in selling at $90 per share. Now, an options contract, a covered call, is when you offer those 1,000 shares for sale at 90 through a specific period of time. We picked October here, knowing that it could be sold at any day during that period, but in exchange, you're receiving option premium or cash flow. Now, an expiration date's always a part of that contract, and it depends on how long you go, but that is going to be the Saturday that follows the third Friday in a given month. And the example that we're going to look at is October, so it's going to be the 22nd of October. So let's review an example of the options quote. So let's take a look at just a general quote sheet. Whether you use Yahoo or Big Charts, you look at your stock symbol. If there's options on it, there'll be an options chain. You click it, and you're going to see a series. I used October as an example. And there's going to be calls on the left and puts on the right, but we're going to just focus today on the calls on the left. Keep in mind you got a lot of information like the last trade, the change in the volume, but I'm going to focus on the bid-ask spread here because that's what we're going to get. Now, in this example, look here, we picked a stock trading at 88.78. So if someone was interested in selling the rights to the shares at 90, well, that's highlighted in yellow. The premium being paid to you is $1.55 per share. If 95 sell limit was more desirable, the premium is about a quarter. So we're going to use that information as we diagram a covered call. All right, so let's have a little bit of fun here and talk about some covered calls. Let's just say hypothetical, somebody has approximately 10,000 shares of company stock. So you got 10,000 shares, and we're considering offering some shares for sale. And in options world, one contract equals 100 shares. So if we're considering selling 1,000 shares, that's really 10 contracts, right? 10 contracts for 1,000 shares. Now, let's just play around for a second and say, okay, we talked earlier about the previous example, the stock's trading around $88 a share. So we'll say the stock's about here. Now, let's assume that we want to sell, we want to get 90. Now, one of the things you could do is offer it for sale at 90. It may or may not get there. You could wait a week, a day, a month, a year, who knows. Alternatively is you could offer it for sale at 90, and if you did that for a period of time, let's just say 2 months through October, then you get compensated for it. And so in the option premium example, you were getting $1.55. So what in essence is happening is you're saying, I'm willing to sell my shares at this price, 90 that you pick, any day, any reason, for any time through October. In exchange, I'm getting paid for it, so I'm getting $1.55. Now keep in mind with respect to options that they will expire on the third Friday of the given month. So a lot of times that's around the 20th of the month, maybe the 17th, 21st, but it's going to be the, well, third Saturday. For us, the last trading day is the third Friday. Now, if you were willing to go out there for 2 months, you received $1.55, and what you're saying is I put a ceiling or a max gain on my shares. And I know the strike price I picked, which is that sell point here at 90, but I got $1.55 up the front, and which is equal to, I'll write backwards, $1,500 plus, right? Because we're doing it for 1,000 shares. And if you, maybe you catch a dividend during that period, maybe you don't, but you know you got a max gain when you add those things all together. Now, alternatively, though, you could say, 90 is kind of close. Somebody else might say they need 95, so they put a ceiling at 95. And let's say they did that through the same time horizon. Well, that was paying a quarter. Okay, so maybe that's attractive. Maybe it's not worth the ticket charge to do it. But what you can see is different strike prices warrant a different premium that you collect. And it's called a covered call because covered meaning you already own the shares. You own them, you're long them, you're offering them for sale at a price. Now, we talked about 2 months, or we talked about, an example through October. But what if you wanted to go, wait a minute, 1, 2, 3, 4, 5 months? You wanted to go out to January, and you also wanted to offer it at $90 a share. Well, presumably, you've given 5 more months, or 5 total months worth of time value so that the price they're going to pay you is a little bit more. And in this case, it was $2.80 a share. So you could collect more, but you're offering it for sale for a 5-month period of time, which is a little bit longer. What you see there is a little flexibility to pick what is suitable for you based on what you're trying to accomplish. Now, I think it's important to note, we keep talking about a ceiling. When you're selling a covered call, you're putting a ceiling. You know the most you're going to get. Is it 90? Is it 95? But what about the loss? If you own a stock, theoretically, it could go to zero. So you really have an unlimited loss except the option premium, that you receive. Now, I also want to think about it for a second, because one of the things that you're doing is offering it for sale for a period of time, but that doesn't mean that the stock cannot trade up and down or above and below this price. So let's say, for an example, the stock's trading like this, and then it goes up here and it trades like this. Well, notice if we go back to the October example, they can take the stock anytime, any reason here. They don't have to wait till that last day right here. At the same vein, if you did this January option for 5 months, the stock could have traded up here in this range for a period of time and was never taken from you. And when the option expires, the stock was trading below that $90. Who's going to pay you $90 for something that you can buy in the market in the 80s? So what happens is that option expires. It's done. It's over with. And if you wanted, you could look out for a new contract. You can see how maybe implementing this or doing this a few times a year could add some cash flow to the equation. But you could also imagine if the stock was to trade and go up to 120, you've got an opportunity to Monday morning quarterback yourself and say, wow, I sold it at 90, plus I got the 280, so I got 90, 280. I got some good money, but boy, I didn't get all of it. And that's what the other side of the equation is doing. They're giving you premium in the hopes that it goes much higher and they can buy it from you at 90. So I hope that helps. It's just an explanation of how options can be a flexible tool. It doesn't protect against loss, though. So maybe that's a good segue to talk about puts. You hear about calls and puts, and maybe the next time we can talk to you a little bit about puts.